Walgreens Boots Alliance is currently trading at a 10-year low, resulting in an unprecedented 179% surge in their dividend yield. Low earnings are causing retail investors to flee from this stock, but should long-term dividend investors be buying the dip? Although quarterly financials are missing estimates, a closer inspection will show us how WBA is both protecting the dividend and the long-term outlook of the company. Let's take a deep dive into Walgreens and see what kind of money we can be earning investing in WBA. So first off, I found this company on Dividend Radar's June 9th spreadsheet, and here we can see that their dividend yield has just topped 6%, 6.03%, and they've been growing their dividend for 48 consecutive years. So they're very close to Dividend King territory. All they're missing are 2 more years of dividend increases. And you've probably heard of Walgreens before. You've probably seen one of their stores around just driving through town. But if you haven't, Walgreens is an integrated healthcare, pharmacy, and retail company. They serve millions of customers and patients every day, and they play a critical role in the healthcare ecosystem. So they have a lot of brick and mortar stores where they sell, over-the-counter medications. They have a pharmacy center in most locations as well. And recently they've been buying urgent care facilities to actually get into the healthcare business. So that's something I want to focus in on a little bit. Right here we can see this is Walgreens' second quarter fiscal 2023 results. So here we can see what they're doing as far as growth is concerned, and they've recently had a few acquisitions. They bought Summit Health. They closed that deal on January 3rd, and they've started integrating the company into Walgreens Boots Alliance. They signed Horizon as a fourth payer partner of Walgreens Health. They've acquired Shields and closed that deal in late December of last year. And they're expected to close the CareCentrix acquisition in Q3 of 2023. And this has resulted in a pro forma sales growth of 30%, exceeding $1.6 billion in the second quarter. So they're very focused on growth right now, and that might be why we're seeing some dips in net income and operating income, and why some people might be seeing that as a bad thing and fleeing from the stock. But if we take a look at Walgreens share price history, we can see here that they're right now trading around $30. And if we look at this horizontal line, we can see that we haven't hit this low of a share price since about mid 2012. July 2012. 2012. We were seeing a share price around $30. And what I really want you to focus on here is the chart actually down here on the bottom, which tracks their dividend yield and payout ratios. So here, if we look at mid-2012, we're seeing a dividend yield around 3%. And this is pretty typical. Between 2011 and about 2019, 2020, we saw dividend yields between 1.5% and 3%. And it's only recently that we've been seeing yields up in the 4s, 5s, and now recently a 6% plus dividend yield. And through this entire time period, they've been increasing their dividend, the actual dollar amount. But their share price has been declining from this about $100 high in mid-2015 all the way down to what we're seeing now in the $30 range in 2023. So as they've been increasing this dividend, the yield has been spiking and has been continuously growing basically since right about here, 2018. Started at 2%, and if you look at that green number down there at the bottom, it increases all the way up to what we're seeing now at 6%. And if we take a look at NASDAQ.com, we can see that their current dividend yield is 6.01%, so a little bit down from what Dividend Radar was showing us, and that's with an annual dividend of $1.92 per share. And we can see here that from 2000, they were paying about 3.37 cents per share per quarter, and now we're up to 48 cents per share per quarter in 2023. So that's a pretty big increase. And if we go over to Digrin.com, we can see that sort of graphically. Over here in 1986, they were paying 0.8 cents per share per quarter. And then right around 2004, 2005, their dividend amount per share just went absolutely parabolic, especially right here between 2010, 2009 maybe, and 2014. Huge increases. And so if you bought, down here in the early 2000s, you're probably very, very happy right now. But recently they've been pumping the brakes, and we're seeing a slower increase, probably as a result of the decline in net income, operating cash flow, and free cash flow, everything we looked at before. So here we can see that in their 20-year dividend growth rate, about 14%, 10-year 8%, 5-year growth rate is 5%, and then their 3-year growth rate is just 2.8%. So definitely slowing down, but with the increase in dividend yield, this may actually prove to be an attractive investment. So that's a little bit about their price history, their current yield, a little bit about their dividend history, and that's all fine and good, but what about the safety of the dividend? And as you probably know, the best metric to qualify the safety of the dividend is the payout ratio. And I like to calculate payout ratios on net income, operating cash flow, and free cash flow, which I've done here. We can see the year end, and this is Walgreens fiscal year end, which I guess is in August. We can see that the payout ratio on net income last year was 38.25%, operating cash flow 42.55%, and then free cash flow at about 77%. So that's very safe. I mean, really, I like to see payout ratios below 75%, and we're just above that number here on free cash flow. And pretty much across the board for the past 5 years, we're seeing payout ratios well below 75%. Now here in 2020, we saw a huge spike in the payout ratio on net income, but obviously that's dropped since then. And all other metrics since then, or prior to that rather, have been below 75%, really below 50%. I haven't seen very many payout ratios above 50%. So although their income is declining, which we're going to take a look at here in a second, the dividend payout ratio and the actual safety of the dividend, I think is very, very secure, especially given the fact that they've been increasing the dividend for 48 consecutive years. It's very clear that they value distributions to shareholders. So they're trying to keep these numbers as low as possible, even with declining financial metrics. And up here we can see what the actual decline has been over the past 10 years. So on net income, we're seeing about a 13% decline per year. Free cash flow, we're seeing about a 4.25% decline. Operating income is declining at 8.56%. Operating cash flow at about 2% per year. And diluted continuous operations has been declining at about 11.2% per year. And this is just a conservative estimation of earnings. So while all that's happening, they've been growing their dividend by 5.05 on a trend over the past 10 years. And obviously we took a closer look at that on Digrin.com, and they're definitely pumping the brakes. And we're going to incorporate that into our income projections later on. But they're still prioritizing distributions to shareholders while their income is declining and keeping very safe payout ratios. So I am concerned about the decline in financial metrics. I know they've been acquiring a lot of companies recently to try to get into the urgent care and more of the actual doctor to patient relationship type of service, more than just the retail, providing over-the-counter medications, prescription medications, and general like convenience store type sales, which I think that type of business is on the decline with, the availability of online prescription fulfillment. You can buy over-the-counter medications on Amazon. You can buy pretty much everything that you can buy in a Walgreens online and just get delivered straight to your door. But if they can tap into actually interacting with patients and providing healthcare services, I think that's a better business moving forward, in my opinion. But what do I know? And also here we can see that their price has been declining. Their share price has been declining at about a 10% pace over the past 10 years. So all that being said, what can we expect to actually earn from investing in WBA today? So here we're on marketbeat.com looking at their dividend calculator, and we are investing, let's see, their current share price, what closed yesterday at $31.51. We're trying to invest about $1,000, so this comes out to a little bit less than $1,000 if we buy 30 shares. And we're looking at an initial dividend yield of 6.01%. That's from NASDAQ.com. And we're looking at Digrin's 3-year dividend growth rate. I'm assuming that they're going to continue to pump the brakes or try to keep the annual dividend amount increase about at what historical inflation typically is, which is between 2 and 4%. I know it's been more recently. So, but if we expect over the next 20 years our inflation to, more or less track with what we've been seeing historically, 2.8% should keep us up with that. Now, the share price appreciation, I'm assuming that we're not going to see very much price appreciation from here. Now, when we go and look at the actual share price action, we're seeing a huge decline over the past, almost 10 years, 8 years. We've seen this huge decline. And we're at a 10-year low. I really don't know if we're going to get all the way back up to this mid-2015 high, but I do expect us to kind of stay in this $30 to $40 band. And I wouldn't count, if you're projecting your income, I wouldn't count on share price appreciation actually contributing an appreciable amount to your your total return. So that's why I'm assuming a 0% share price appreciation. And we have quarterly distribution, we have drip investing on, 15% dividend tax rate, and no additional annual contributions. So let's see what we're looking at in terms of our income. So down here, we're looking at a yield on cost of 36.96%, which isn't bad, but it's not super great. An average annual return of 6.93%, and an annual dividend income amount of $391.75. And over 20 years, a little over $3,000 in total dividend income. So this average annual return is below what you could expect investing in the S&P 500 index. The yield on cost is not very high, but it's an attractive investment. It's really the average annual return gets pushed down massively when you don't have any share price appreciation, and the fact that there's not very strong dividend growth, the actual dividend increase amount, causes this yield on cost to drop substantially. Yesterday we analyzed TDS, which has been seeing pretty strong growth, I think around 4 or 5%, and we assumed about a 3% share price appreciation, and we were seeing yields, our yield on cost was over 100%, and the average annual return was almost twice what it is for Walgreens at about 12.1%, I think is what it was. So really you want to be both investing for dividend growth and capital appreciation. I mean, if you can get both at the same time with an attractive yield, that's really the holy grail of dividend investing. But that's pretty much it for Walgreens stock. I don't know if I'm going to be buying into this stock. I know their dividend yield has spiked quite substantially over the past couple years and few months, but the negative financial metrics, these declines in net income and free cash flow and operating income, is really concerning to me. And unless they can get those numbers up over the next few quarters and increase their dividend along the way, then maybe at that point, once their financial numbers start to look a little bit more attractive, and if we're still trading in this $30 to $40 range, I'll probably buy in at that point. But that's it for this analysis. I hope you guys enjoyed this video. If you did, make sure you like this video, leave a comment, let me know what you think, and make sure you subscribe to the channel. And I mentioned in a previous video that I've been working on a web app to kind of automate a lot of this analysis and make it a little bit more accessible, not just to you guys, but also for me. I hate going to all these different websites to find out these numbers, and if I could just get them all in one place and have it all in sort of a dashboard format, that's going to make it much easier for me, and I think much easier for y'all to actually analyze dividend paying stocks and see if they are a good fit for your financial situation. And I want to make this a free resource. So these types of data sources do cost money, and I'm trying to figure out a good way to actually cover that cost while also providing, this free service to you, my viewers, and anyone else who wants to actually look into a dividend paying stock. I'm considering probably like a a donation structure like a Patreon or something like that. Um, but we'll see. We'll see. That's a little bit in the future, but the website is coming along very well, and I expect to have it pretty much done in less than a month. So here about mid-July, you should be seeing an announcement from me about that. Um, and if you want to sort of help me beta test it, there's definitely going to be a staged rollout. You can email me at the email that I'll leave in the description, or also the inquiry email on my YouTube page. And maybe if you're willing, I could get you some access to the website sort of before the launch, and you can give me some feedback. That would be much appreciated. But other than that, guys, that's all I have for you. As always, stay safe and take it easy.